Hello, my fellow investors, and welcome back to another fundamental analysis video. Guys, the next week is going to be jam-packed filled with companies. However, for this video, I actually want to take a look at a company that two people recommended here on the channel. It's actually Serena and Tony asking for ADM because it was a massive fall, 20+% a few days ago. And well, there's a company that it's actually kind of interesting. The reason why they fell is something that we're going to cover, as well as, of course, their fundamentals to see if maybe we could take advantage of this downturn, right? Because if the reason why they fell may not have been a big deal, or, it's something transitory that will eventually pass, then this might be a great opportunity to buy this company. I didn't really know about this company. They make food products. However, when you go to the store, you don't really take a look at the brands when it comes to the types of food that you buy, right? You just buy the foods that you like. So let's actually take a look at what they actually produce for us. So taking a look at the company profile, we can see the company operates in three segments: AG services and oil seeds, carbohydrate solutions, and nutrition. It originates, merchandise, stores, and transports agricultural raw materials such as oil seeds and soft seeds. The company also engages in agricultural commodity and feed product import, export, and distribution, and structured trade finance activities. In addition, it offers vegetable oils and protein meals ingredients for the food, feed, energy, and industrial customers. Crude vegetable oil, salad oils, margarine, shortening, and other food products, and partially refined oils to produce biodiesel and glycols for use of chemical, paints, and other industrial products. So when it comes to this, guys, I'm not really a fan of oil seeds, right? I'm not really a fan of carbohydrated solutions or anything of that sort. At least in my household, we do not cook with canola at all or any kind of vegetable oil, because at the end of the day, I do not like them and I think they're really unhealthy for you. However, on this channel, we talk about investing. And at the end of the day, people are going to buy them because of the fact that they are cheap, right? They're not going to stop buying these types of products just because it is considered unhealthy. Obviously, I'm the kind of person that I look at this, I'm like, I would never buy any of these things, especially margarine. That's awful for you. However, from an investing standpoint, let's take a look at their numbers and see whether or not we want to buy into this company. Again, there is no such thing as moral investing, because at the end of the day, either if you don't buy it, somebody else will, and that person that is buying it will have an effect on the stock. So let's now move into what in the world's been happening with this company as of recently. So, as of January 22nd, ADM shares plunged 24% in worst day since 1929 as CFO is placed on leave. It goes on to say shares of Archer Daniels plunged 24% on Monday, its biggest one-day drop since 1929 after CFO Vikram Luthar was placed on administrative leave as the company investigates accounting practices at its nutrition segment. The global grain merchant cut its 2023 profit forecast and said fourth quarter results would be delayed due to investigation related to a certain inter-segment transaction in response to a voluntary document request by the U.S. Securities and Exchange Commission's SEC. The probe brings more uncertainty to ADM's high-margin nutrition segment, which is under pressure due to weak demand for meat alternatives and other products, as well as downtime at a large soy processing facility. So what in the world was this controversy? Obviously, we just saw that one of the execs got put on leave, but for what reason? ADM accounting scandal zeroes in on nutrition unit that was key in boosting exec stock bonuses. There you have it, guys. There you have it. It got boosted to more than $70 million. So this article goes on to read that the division of Archer Daniels Midland Company that's under investigation for its accounting practices is responsible for less than 10% of the Crop Giant's revenue. Yet it has had an outsized influence in recent executive bonuses, records show. ADM's board in 2020 and 2021 stacked a considerable share of senior executive stock award payouts to the profitability growth of its nutrition unit. The company blew past the goals for the first round of awards, helping the executives collect shares worth more than $70 million. Payouts for the second round of awards were said to be determined earlier this year. So basically what had happened is that this guy, Vikram Luthar, essentially fudged the numbers to give themselves a much higher payout than they were actually supposed to get, which is causing this whole controversy. And it got to the point that, yes, this was a big scandal, but it also got downgraded. UBS downgrades Archer Daniels to neutral, lower growth and margins. Since they fudged the numbers to begin with, now that things are coming to light, well, now they're getting downgraded, which aided in the stock falling 24% as of this past week. So let's take a look at the discounted free cash flow. We got the ticker for ADM, market cap of $27.8 billion, a P of 7.25, current share price of $52.05. If we take a look at this, we can see that this thing is down in the 1 year 38.69%. On the year to date, this thing is down 28%. We're near the 52-week lows at $50.72, 52-week high of $87.30. Now, as of Friday, the 26th, we can see that this actually gained around 1.3% on intraday and 1.34% post-market. So there is some recovery going on here. I guess people are buying back because of the fact that they did fall. However, I really want to take a look at their fundamentals and see what in the world is happening here. Coming back over here, we can see that they do pay out a dividend. In fact, there's a lot of articles being written that even though this thing is currently happening, they can still afford the dividend. Well, I would actually argue they can't, but we'll see what the calculator actually says. Nonetheless though, annual dividends of $2 per share, which ends up being a yield of 3.84%, a payout ratio of 23.21, a 5-year CAGR of 6.08, 30 consecutive years of dividend payment. Ex-dividend date is coming up on February 7th. Payout date will be on the 29th. This is a leap year. Wow, I can't believe that. And the dividend frequency, it is quarterly. If we come back over here, based on the current shares outstanding and this $2 in annual dividends, they pay out $1.1 billion every single year. And if we take the 5-year average free cash flow, subtract this $1.1 billion, they're left with negative $2.57 billion. This is a problem. As of the last year's free cash flow, they're left with $1.1 billion. And these payout ratios are, this is where I'm kind of confused as to why people are saying, but the dividend is safe. Is it really safe? Sure, as of the last year's free cash flow, the payout ratio is about 50%. The 5-year average, though, is in the negative. Yeah, guys, their cash flow is actually in the negative. We're going to take a look at that in just 1 second, and I'm also going to explain as to why this isn't a good thing. Because it's not the normal case where CapEx exceeds cash from operations. It's a million times worse. So with that, let's jump now into the fundamentals. Now, before we move on, I want to premise something though. This 1 year ago value is actually 2022. Because of the controversies, I am taking this as 2023 hasn't happened yet for them. So COVID is actually 3 years ago for them. All right, so just FYI. 5 years ago of $1.8 billion to 2022 of $4.34 billion, increase of 140%. There was a downturn 4 years ago, but ever since then, they did continue to increase it. So as you can see, this isn't really even that bad. I would say like an 80% for this net income. Looking at now the free cash flow, this is where things begin to get real bad. We got 5 years ago of negative $5.63 billion to 1 year ago of $2.16 billion. There's an increase of 138% sure. Average though of negative $1.51 billion. Now, normally, if the CapEx exceeds the cash from operations, I would say, okay, so they're reinvesting back into the company. However, in regarding this specific free cash flow, we can see that the cash from operations in 2018, 2019, and 2020, 2020 is a little bit explainable, but 18 and 19, negative 4.8 billion, negative 5.45 billion, and then 2020, negative 2.4 billion. Only in 2021 did this come into the positive. As you can see, as of the trailing 12 months, this is now to around $2 billion. So this is very concerning, right? Cash from operations being negative, major point of contention where I'm like, what in the world happened here? I'm looking at this. There could be some explanation for it that may be benign. However, I look at this just from a 10,000 foot view and I'm like, absolutely not. This is very concerning. So I look at this and I'm just like, this is an atrocious graph, 0%, guys. Looking at the revenue, we can see that 5 years ago, we got $64.34 billion. To 1 year ago of $101.56 billion, increase of 57.84%. Looks similar, actually it looks a little bit better than that of the net income. So I'm going to give it, guys, an overall grade of like a 95%. Looking now at the assets minus the liabilities, this looks absolutely perfect. The trend line hits those graphs almost every single time. Average total assets being $53 billion, liabilities of $30.5 billion, difference of $22.47 billion. I'm going to give this a solid 100%. It really is a great assets minus liabilities. Now, the cash flow minus the liabilities is actually surprising. I was expecting this to be a whole lot worse. We can see consistent decrease from 5 to 3 years ago. They did pretty well 2 years ago, and then they brought it back down to negative $33 billion as of 1 year ago, 2022. where the average for all the past 5 years is negative $30.44 billion. Honestly, it's not too bad. It is decreasing, but all in all, I would say at around like, I don't know, 60% for a grade when it comes to the cash flow minus the liabilities. The shares outstanding, as we can see over here, doesn't look too bad either. 5 years ago of 559 million shares to today of 535 million shares. Decrease of 4.29%. Previous year to the current year, 547.1 1 year ago to today of 535, decrease of 2.21%. They increased at one time, and that was 2 years ago. 3 years ago was COVID. The following year, 2021, I guess recovery, but they found that maybe they just issued a little bit. They issued by 4 million shares. Not even too bad. I'm going to say, guys, a solid, 100%. I was going to put 95, but this right here is explainable. And lastly, cash and equivalents. They currently hold 1.5 billion with an average of 1.2 billion dollars. For the overall grade, well, we can see that a 0 in cash flow is bringing this thing down a whole lot, right? 66% grade. It could be better. Honestly, this thing could be a solid like 80 plus company, 85 plus company. Problem is the free cash flow, guys. I'm sorry. Honestly, if I was looking at this, if I was looking to invest in this thing and I saw that free cash flow, that cash from operations being like that, I wouldn't even go any further, right? I would just stop right there. So 66% is, I guess you could say, decent. And in most cases, I would say do more research on it. This one, the free cash flow being that bad, still do more research on it if you want to invest in it. But for me, I'm just like, I'm out. This one is just, it's just not good for me in the slightest. Now, if we actually take a look at the discounted free cash flow, this one's actually really interesting. Not inputting anything, not adjusting for debt, we got $99.91. Adjusting for debt, $87.76. Let's input some of this. So for the share buyback, they've been doing around 4.3%. If they were smart, which I don't know if they are after the scandal, but then again, there was just one guy. But I think that they might begin to buy back shares, seeing that they just plunged 24%. In the past 5 years, they've done around 4. So let's put that as the median at 4, maybe even 5, honestly. And let's bring this down to 3 for the lowest. And let's go up by 2 again for 7 for the highest assumption. Now, in regards to their revenue, Seeking Alpha has this thing gaining revenue at around 2.99%. And the sector median is around 5.16. So I'm going to say, guys, for the lowest assumption, let's say 2. Then let's say, let's just bring this up by 3. Let's say 5. And then let's bring this up by 3 again. And then let's say 8%. And with this, we get $110.58 to $141.70. And then adjusting for debt, $98.05 to $128.65. Margin of safety of 5, 10, and 15, $83.34 to $122.22. So by the looks of this is looking like a great buy right now. Current price of $52.05. Again, this kind of free cash was telling me great buy. Fundamentals, specifically the free cash flow, may be something that for you guys is maybe explainable. Again, if you guys know, let me know in the comment section below. I really am interested to know if you guys know something about this, because if it's benign and if it's just a transitional thing, just like the scandal is, which I do believe the scandal is transitional, right? You got a company like WM that also had similar things happen to them in the past, and yet look at them now, right? So it does have, there is always, I guess, a redemption arc for companies if they play their cards right, which they got rid of their CFO. I think they are playing their cards right, but do more research on that 5, 4, and 3 year ago cash from operations. See what comes up. If you think it's fine, then by all means, buy into it. Let me know in the comment section below, right? What you guys think. Of course, not financial advice. Every investment is the present value of all future cash flow. All of these calculators are available for free. Now, looking at this dividend, if we invest $5,725, this nets you almost $220 in annual dividends. It's almost a 4% yield. Not really surprising. Now, a lot of people are saying that the dividend is still safe. I do not think so based on their 5 year average free cash flow. But again, do more research as to what in the world happened to cause the cash from operations to go into the negative 2018 and 2019. So all in all, that was ADM. Again, cash from operations is the big problem here. Everything else looks pretty solid, right? They're one of the few companies out there that, produces food and distributes it. Really hard industry to get into. Lots of regulation. Pretty, they have a pretty, I guess, moat. Like a pretty good moat, I guess you could say. Might be one that you would consider. But again, please do your own due diligence. Anyways, that pretty much does it for this video. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube. And of course, make sure to follow us on X. So, with that said, peace out. And we'll see you all next time.